Friends, thank you for being here today. What if I told you that the very foundation of the global economic order, the unshakable assumption that American debt is the safest asset on earth, is crumbling before our eyes? It implies a far more terrifying reality. What happens to your livelihood, your savings, and your future when the entities responsible for propping up the American standard of living quietly decide to head for the exit? For decades, the United States has enjoyed an exorbitant privilege. We have been the issuer of the world's reserve currency, allowing us to print money to pay for goods, fund wars, and finance massive deficits, all because the rest of the world was willing to hold our debt. They bought our treasury bonds because they were considered risk-free, but that era is ending. We are currently witnessing a geopolitical and geofinancial shift of tectonic proportions. The data is flowing in, the receipts are verifiable, and the narrative is undeniable. Foreign central banks are dumping U.S. debt at alarming rates. To understand why this is happening and why it signals a potential implosion of the U.S. economic model, we must look beyond the daily stock market tickers and partisan bickering. We must look at the plumbing of the global financial system. We are going to explore the deteriorating state of U.S. fiscal health, the mechanics of this foreign divestment, the specific role of Japan, the Ponzi dynamics of our current debt management, and ultimately, how this transfers wealth away from the working class to the asset-holding elite. Let's begin by examining the deteriorating state of U.S. fiscal health. The story begins with the sheer, unmitigated scale of the burden we have placed upon ourselves. As we stand here today, the U.S. national debt has surpassed $38 trillion to the average citizen. A number that large is abstract. It sounds like monopoly money. But in the world of sovereign finance, it is a flashing red siren. To understand the gravity of this, we must look at the historical context. The United States has not always been a reckless borrower. Our debt story began in earnest with the Great Depression and the necessary spikes in spending during the Second World War. However, through various mechanisms of financial repression and rapid post-war growth, the U.S. government managed to keep a lid on the total level of debt relative to the size of the economy. For decades, adjusted for inflation, the debt was manageable. That discipline evaporated in the 1980s. The Reagan administration exploded the deficit through a combination of massive military spending and significant tax cuts. This set a precedent that has been followed by almost every administration since, regardless of party affiliation. Since then, we have been on an unprecedented run of borrowing. We funded our deficits by selling interest-bearing treasuries to the global market, which loaded us up with dollars but also with debt. For a long time, we got away with it. We pulled it off because debt service as a percentage of GDP was manageable. We were in growth mode, fueled by deficit spending. And most importantly, as the world's reserve currency, there was an insatiable appetite for US dollars. So long as we were growing, stable, and the reserve currency, there was no reason to panic. Today, however, the math has broken. The most notable and terrifying change is the percentage of the federal budget that must now go towards servicing this debt. Interest payments on the national debt have doubled in just 5 years. According to the St. Louis Federal Reserve, in 2020, America paid about $514 billion in interest. Fast forward to the first quarter of 2025, and that number has exploded to $1.1 trillion. That is nearly a 100% increase. When interest payments double in 5 years, it is not because the country doubled its population, its productivity, or its income. It is because it doubled its borrowing costs. Interest payments on our debt now consume approximately 15% of the total federal budget. This expenditure is now second only to Social Security and is tied with Medicare. Even more alarmingly, in early 2025, interest payments accounted for 35% of all U.S. tax revenue. Think about the implications of that statistic. More than 1/3 of every tax dollar collected from your paycheck is not going to roads, schools, defense, or healthcare. It is going into a black hole just to maintain existing debt. This rising interest burden dramatically reduces fiscal flexibility. If this trend continues, future Congresses will not have the funds to solve problems or react to crises. They will barely be able to keep the lights on. With the baby boomer generation aging, costs for Social Security and Medicare are set to skyrocket. With tax cuts reducing revenue, we have to fill the gaps with the only two levers we have left: tariffs and more debt. And as the debt grows, the interest grows, creating a doom loop that is becoming mathematically impossible to escape. This reality brings us to the credit rating downgrades, which serve as critical warning signals. This fiscal deterioration has not gone unnoticed by the arbiters of global creditworthiness. For decades, the U.S. enjoyed a pristine AAA credit rating, the gold standard of finance. A credit rating is essentially a report card for a borrower. And when you apply for a mortgage, the bank checks your credit score. Countries have ratings issued by agencies like Moody's, S&P, Fitch, and Scope Ratings. In recent years, the United States has faced credit downgrades from all major agencies. S&P downgraded the U.S. back in 2011. Fitch followed suit in 2023, Moody, S, and Scope have also taken action, moving the United States from its top-tier status to lower tiers like AA+. There is a tendency in the mainstream financial press to dismiss these downgrades. They argue that because the U.S. prints its own currency, it can never technically default. While it is true that no one is worried the Treasury won't cut the check for the next interest payment, this misses the point entirely. A downgrade is not a prediction of immediate default, it is a signal. It is an early warning alarm telling investors that America's long-term fiscal path is unsustainable. When agencies downgrade the U.S., they are citing specific structural failures. They point to rising national debt, growing deficits, and high interest costs. But perhaps most damningly, they cite the weakening of governance standards. Scope Ratings, for example, stated bluntly that policymaking is becoming less predictable and that Congress is struggling to address long-term challenges with seriousness. We see this in the political gridlock that makes fiscal reform almost impossible. Tax cuts are extended without offsets. Mandatory spending continues to rise. Social Security and Medicare remain politically untouchable despite massive unfunded liabilities. Each year, it becomes harder to reverse course. The agencies are looking at Washington and seeing a government that has lost the ability to budget, relying instead on continuing resolutions and brinksmanship. These downgrades matter because they influence behavior. They act as a signal to the global market. When a rating agency says, "We are concerned," investors pause. They reassess the risk. They demand a higher return for lending money to a riskier borrower. This pushes up interest rates on newly issued government bonds, which in turn increases the cost of borrowing for everyone in the economy, further exacerbating the debt spiral. This leads us directly to the dumping mechanism and the reasons why foreign central banks are selling. This brings us to the core of the crisis, the behavior of our creditors. For the last 75 years, the currency of global business has been the dollar. We fund our deficits by selling treasuries to the world. Foreign central banks have historically been the most voracious buyers of this debt, holding trillions of dollars in U.S. treasuries as a safe store of value and to manage their own currency exchange rates. However, the tide has turned. We are no longer just witnessing a slowdown in buying. We are witnessing an active sell-off. We verify this through the Treasury International Capital, TIC, data releases. These reports, though they lag by a few months, provide the most accurate picture of cross-border capital flows. The recent data is stunning. In the past, during times of global economic uncertainty, foreign capital would flock to the United States. We were the safe haven. Even if things were bad in America, they were presumed to be worse everywhere else. That dynamic has inverted. In the 12 months ending October of last year, central banks invested $31 billion more in U.S. treasuries than the U.S. invested outside. That was the old normal. But through October of the current period, that number reversed dramatically. We saw a net outflow of $100 billion from foreign official sources. This is the definition of selling America. This means that foreign governments are not just buying less, they're actively divesting. They're selling U.S. assets more than they are buying them. This trend is not isolated to government sources. Private sources, corporations domiciled outside the U.S., are showing similar hesitation. Why is this happening? It is a combination of economic necessity and geopolitical strategy. Economically, other nations are losing faith in our long-term ability to manage our debt. They see us cutting taxes we can't afford, shutting off immigration which stifles growth, and engaging in erratic trade wars. Geopolitically, the weaponization of the dollar through sanctions has taught the world a hard lesson. If you hold your reserves in dollars, the U.S. can freeze them if you disagree with their foreign policy. This has accelerated the move toward diversification, leading central banks to buy gold or other assets instead of U.S. debt. I want to pause here for a moment because this is a critical point. Do you believe these nations are justified in dumping U.S. debt to protect their own economic sovereignty? Or do you view this as a strategic betrayal of the global financial order? I would love to read your perspective on this. Please leave a comment below with your thoughts. To fully grasp the mechanics of this sell-off, we must look at the Japan factor and the unwinding of the yen carry trade. To fully grasp the mechanics of this sell-off, we must look at Japan. Japan is far and away the largest official owner of U.S. debt, holding over $1 trillion in treasuries. For years, Japan has been the reliable anchor of U.S. deficit spending. But Japan is now having its own economic moment, and it is a nightmare scenario for the U.S. Treasury. The relationship was built on the yen carry trade. For decades, the Bank of Japan, BOJ, ran near zero and sometimes negative interest rates. Meanwhile, U.S. interest rates were higher. Global investors and Japanese institutions would borrow yen for almost free, convert them into dollars, and buy U.S. treasuries to pocket the difference in yield. It was an arbitrage machine that funneled massive liquidity into the U.S. debt market. That machine is breaking. Japan is now battling its own inflation. To combat this, the BOJ has been increasing interest rates over the last year. The new government in Japan is trying to slow the pace of inflation by gradually hiking rates, a trend that is expected to continue. As a result, the yield on Japanese 10-year treasuries has increased dramatically, approaching 2%. Simultaneously, the yen has been volatile. The primary reason Japan bought so much US debt was that the yen was low compared to the dollar, and their yields were zero. But now, the US dollar is losing value, down significantly in recent times due to domestic policies, and Japanese yields are rising. The arbitrage play is no longer attractive. In fact, it has become risky. This leads to the unwinding of the carry trade. Investors are shedding US positions to pay back their yen loans or to repatriate funds into Japanese assets, which now offer a decent return without the currency risk. For Japanese firms, this is simply a matter of bringing money home. The political implications are stark. We have seen US Treasury officials pleading with Japan to stop raising rates, to keep the spigot of cheap money flowing. But Japan has effectively given the US the middle finger. They are signaling that they must prioritize their own economic stability over financing American profligacy. When your biggest lender tells you they are cutting up the credit card, you are in deep trouble. And that is exactly what is happening between Tokyo and Washington. This situation forces us to confront domestic mismanagement and the Ponzi dynamics of our current debt management. With foreign buyers fleeing, how is the U.S. Treasury managing to keep the system afloat? The strategy currently being employed reveals the desperation of the situation and highlights the Ponzi nature of our debt financing. The Treasury Secretary, facing a wall of debt maturities, has been shifting away from long-term bond auctions to load up on short-term notes. We have more than $9 trillion in U.S. debt coming due in 2026 alone. This is staggering. By relying on short-term debt, bills and notes that mature in less than a year, the Treasury is trying to lower the immediate interest cost, as short-term rates can sometimes be lower, or at least offer more flexibility than locking in high rates for 30 years. However, this strategy carries immense risk. It creates a rollover crisis. Every time these short-term notes mature, which is constantly, the Treasury must find new buyers to pay off the old ones. If demand dries up for even a moment, or if interest rates spike, the cost of refinancing that debt explodes. This is where the Ponzi comparison becomes apt. In a Ponzi scheme, you pay early investors with money from new investors. The U.S. government pays off maturing bonds by issuing new bonds. This works as long as there is an endless line of new investors. But as we have established, the foreign line is disappearing. So who is on the other side of the ledger? Increasing, it is us. The Federal Reserve creates money for the express purpose of buying our own debt. It sounds counterintuitive, printing money to lend to yourself, but it is the primary mechanism for maintaining liquidity when real buyers vanish. This is monetization of the debt, plain and simple. Furthermore, there are deep anomalies in the data that suggest shadow financing. Treasury data lists the Cayman Islands as a massive holder of U.S. debt. However, Federal Reserve papers have shown discrepancies of up to $1.4 trillion between what the Treasury reports and what is likely held by hedge funds domiciled in the Caymans. This suggests that a significant portion of U.S. debt is being shuffled through opaque, high-risk financial vehicles. We are counting on accounting errors and shadow banking to hide the fact that genuine demand for U.S. Treasuries is collapsing. The strategy is clear. Fuel deficits by issuing more debt of shorter duration, force domestic institutions to buy it, and print money to cover the rest. It is a desperate juggle to keep interest rates from spiraling out of control, effectively parking the car in front of the fire hydrant while the house burns. We must also consider the systemic consequences of this collapse and its impact on the banking sector. The collapse of the Treasury market is not just a problem for the government, it is an existential threat to the banking system. U.S. Treasuries are the foundation of modern banking. They are used as collateral for loans, they are held as risk-free capital reserves, and they underpin the entire derivatives market. When the value of Treasuries falls, which happens when yields rise due to selling, the balance sheets of banks take a massive hit. We saw this in the regional bank failures of 2023. Banks that had loaded up on treasuries when rates were low suddenly found themselves insolvent when they had to sell those assets at a loss to cover withdrawals. This is why credit rating agencies like Moody's haven't just downgraded the U.S. government. They have also downgraded the outlooks for major American banks like J.P. Morgan, Bank of America, and Wells Fargo. These institutions hold mountains of U.S. government debt. If treasuries become riskier, the institutions built on top of them become riskier too. This contagion raises funding costs for banks. When banks have to pay more to borrow, they charge more to lend. This tightens capital requirements and dries up liquidity in the real economy. It increases volatility and fragility. When the foundation shakes, the skyscraper sways. But the pain is not limited to Wall Street. The average American consumer is the ultimate victim of this dynamic. Treasury yields act as the benchmark for almost all consumer interest rates. When foreign central banks dump U.S. debt, yields go up. When yields go up, mortgage rates go up, auto loan rates go up, credit card interest rates go up. We are already seeing this. Despite the Federal Reserve cutting its core interest rate to try and juice the economy, long-term market rates remain stubbornly high. The 30-year mortgage rate is detached from the Fed funds rate because it tracks the 10-year Treasury yield. As long as there is a sell-off in the bond market, the cost of living for the American family will continue to rise. Businesses face expensive financing for expansion or hiring, which leads to stagnation and layoffs. The credit downgrade is effectively a tax on every American borrower, levied by a global market that no longer trusts our government's solvency. Furthermore, we are witnessing a massive shift to alternative stores of value, which is widening the wealth gap. If foreign entities and smart money are dumping U.S. debt, where are they putting that capital? The data reveals a fascinating and disturbing divergence. And while central banks are selling treasuries, there is still a net inflow into the U.S. stock market. In October, while $24.8 billion left the debt market, the U.S. stock market took in a net of $7 billion. This seems contradictory. Why buy the stocks of a country whose debt you are dumping? The answer lies in the search for a store of value in an inflationary environment. Investors know that the U.S. government's response to this debt crisis will inevitably be to print more money. They will devalue the dollar to inflate away the debt. In such an environment, cash and bonds, which pay a fixed return in devaluing dollars, are trash. You want to own assets that will rise in price as the currency falls. This has turned the stock market into a proxy for gold. The S&P 500 is no longer just a reflection of corporate earnings, it is an inflation hedge. Its trajectory tracks closely with gold prices. Valuations have detached from reality. Metrics like the Buffett indicator, market cap to GDP, or the Shiller P/E ratio are at historic highs. They are broken because the market is not being driven by fundamentals. It is being driven by liquidity fleeing a dying bond market. This dynamic exacerbates the wealth gap in America to a revolutionary degree. We are witnessing a bifurcation of the economy based on asset ownership. On one side, you have the asset holders, primarily the baby boomer generation, corporations, and the wealthy. They own the homes, the stocks, and the gold. As the government debases the currency to service its debt, the nominal price of these assets skyrockets. Their net worth on paper explodes. The inflation of asset prices protects them from the inflation of the currency. On the other side, you have the wage earners, Gen X, millennials, Gen Z, and the working class. They do not hold significant assets. They trade their labor for dollars. As the dollar is debased, their purchasing power collapses. Their wages may rise slightly, but never fast enough to catch up with the cost of housing or the cost of living. The entire economic structure is now designed to protect the 60-plus population and the asset-holding class. We extract value from the public through inflation to service debt and pour money into programs like Social Security and Medicare that benefit the elderly. We print money that flows into asset markets, making homes and stocks unaffordable for the young. It is a form of intergenerational theft. If you are entering the market now, looking to buy a home or build a portfolio, you are out of luck. The ladder has been pulled up. The American dream of working hard to buy a house is being mathematically eliminated by a debt-based monetary system that requires perpetual inflation to prevent collapse. Before we move on to the final part of this analysis, I have a small favor to ask. If you are finding value in this breakdown and want to stay ahead of these economic shifts, please take a moment to hit the like button and subscribe to the channel. It really helps us get this crucial information out to more people who need to hear it. Finally, we must examine the inescapable trap that awaits the Federal Reserve: yield curve control and the end of sovereignty. As foreign central banks continue to dump U.S. debt and domestic banks reach their saturation point, the United States faces a mathematical event horizon known in economics as the fiscal dominance trap. The mechanics of this endgame are brutal and, unfortunately, inevitable given the current trajectory. When the supply of treasuries overwhelm demand, the price of those bonds falls, which means the interest rate or yield on those bonds must rise to attract new buyers. In a normal market, this is a self-correcting mechanism, but for a government with $38 trillion in debt, normal is no longer an option. If interest rates on U.S. debt were allowed to rise to a true market clearing level, say 6%, 7%, or even higher, the interest expense alone would consume the entirety of federal tax revenue. The government would technically be insolvent overnight, unable to fund the military, Social Security, or the basic functions of the state without borrowing even more. This is the definition of a debt spiral. The Federal Reserve, therefore, cannot allow rates to rise that high. It has only one weapon left in its arsenal, a weapon of last resort that has been used by failing empires throughout history: yield curve control, YCC. Yield curve control is effectively the nationalization of the bond market. Under this regime, the Federal Reserve declares a cap on interest rates, for example, stating that the 10-year Treasury yield will not exceed 4.5%. To enforce this cap, The Fed must print an infinite amount of new dollars to buy every single bond that the market is trying to sell. If China sells, the Fed buys. If Japan sells, the Fed buys. If your pension fund sells, the Fed buys. The Fed becomes the buyer of first, last, and only resort. While this strategy keeps the government solvent on paper by keeping borrowing costs artificially low, it destroys the currency. By printing trillions of new dollars to buy unwanted debt, the Fed floods the global system with liquidity that has nowhere to go but into the price of goods and services. This is not the transitory inflation of supply chain shocks. This is structural monetary debasement. It signals to the world that the U.S. bond market is no longer a free market, but a managed utility of the state. This is the specific scenario that foreign central banks are front-running. They are not selling because they need cash today. They are selling because they know that once YCC begins, the value of the dollar will be sacrificed to save the bond market. They understand that the United States has backed itself into a corner where it must choose between two disasters: sovereign default, telling creditors we won't pay, or hyperinflationary depression, paying creditors with worthless paper. History tells us that politicians and central bankers, when faced with this choice, will always choose inflation. They will choose to print. This endgame creates a feedback loop of doom. As the Fed prints to buy bonds, inflation rises. As inflation rises, rational investors want to sell their bonds because the fixed interest payments are losing purchasing power. This selling pressure forces the Fed to print even more to keep yields capped. It is a centrifugal force that rips the value of the currency apart. This is why the dumping of debt we are seeing today is not a cyclical fluctuation. It is a structural exodus. The world is voting with its wallet, and the vote is a no-confidence motion against the future purchasing power of the US dollar. To conclude, we must recognize that we are living in a fragile house of cards. Friends, the picture I have painted today is not optimistic, but it is necessary to see. We are living through the end of an era. The exorbitant privilege of the US dollar is being challenged not by a foreign army, but by the cold, hard math of compound interest and the rational decisions of foreign creditors. The US economy is in a perilous state. Our sovereignty is being eroded by our dependence on foreign financing. The dumping of US debt by foreign central banks is the canary in the coal mine. It is the signal that the world is preparing for a future where the United States is no longer the undisputed financial hegemon. We have turned our financial system into a Ponzi scheme, relying on new debt to pay old debt while our creditors slowly back away. We are cannibalizing our own banking system and crushing the American consumer with higher interest rates to keep the charade going. And in a desperate attempt to keep the wheels on, we are inflating asset bubbles that enrich the wealthy while destroying the purchasing power of the working class. The question, why hasn't the stock market crashed, is answered by the same logic that explains why your grocery bill is up. The dollar is losing value. The stock market is rising, not because the economy is healthy, but because it is inflating. It is a fever, not a growth spurt. As governance standards weaken and political gridlock continues, the ability of the U.S. to pivot or reform diminishes. We are sleepwalking into a sovereign debt crisis. The downgrade of our credit rating was the warning. The sell-off by Japan and others is the beginning of the impact. What happens next depends on how long the illusion can be maintained. But one thing is certain. The era of easy money, funded by the rest of the world, is over. The bill is coming due, and unfortunately, it is the American people, not the politicians who spent the money, nor the bankers who profited from the trades, who will be left to pay it. Stay vigilant. Understand that in this environment, diversification is survival. Do not rely on the narratives of those who are paid to keep you calm while the house is on fire. The data is there for those willing to look. The collapse hasn't just started. It is well underway. The only open question now is how fast the unraveling will accelerate. Thank you.